Hey, it's Jim, and this is level 3 of the CFA program, the constructed response set on the topic of performance measurement. We'll go ahead and cover learning module 2, investment manager selection. And there are 3 LOSs that we'll talk about during this essay number 2. I know many of you like to read the question first, so I'm going to go ahead and skip down to the questions now. Those of you who don't want to read the questions first, go ahead and close your ears and your eyes for just a minute. Question 1, describe 2 potential benefits of the signal creation process. So let me just remind you, inside of this learning module, there are 3 elements of this, this idea of generating ideas, signal creation. Those 3 elements were uniqueness, timeliness, and being able to be evaluated differently or uniquely or something like that. Question 2 asks us for the signal capture. What we're trying to do here is we're trying to capture the idea that we just created or generated, and the capture also implies that we turn it into some kind of an investment decision. Question 3 will calculate up and down market capture ratios. I think that'll be pretty straightforward. Those are easy calculations. And then finally, we'll talk about incentive fees, a little bit of volatility, and some behavioral issues. So those of you who closed your eyes and ears, feel free to open them now. So let's talk about quantum asset management. Specializing in active equity strategies. So flagship product is a fund. It's called the Quantum Alpha Fund. Consistently outperformed its benchmark over the 5 years. There's Sarah reviewing the fund's investment process and performance metrics to present to potential clients. So let me just go back here. What are we doing here? Performance measurement and investment manager selection. So that first part of the vignette, kind of just confirms that we're inside of this topic area. 2 stages of the investment process. So here's this signal creation, a proprietary quantitative model. Ooh, that sounds pretty sophisticated, but we've been through all these proprietary quantitative models. I mean, we haven't really done any of them in level 3, but we've studied them, so we pretty much know what they look like. So the question then becomes, how proprietary is it? Maybe proprietary over here and proprietary over here for these 2 firms. Maybe they're the same proprietariness. Is that a word? So we're not quite sure about that one yet. Sounds good. Sentiment analysis of earnings call transcripts. Well, that might be interesting. Let's go ahead and read the transcript and try to figure out what people are thinking. That sounds like a behavioral issue as well. And then trying to identify trend analysis through alternative data sources. Yeah, that sounds like a good one too. Now remember, I say this to you guys back in level 1, level 2, and level 3, and you have all of these ratios and other formulas memorized, but the important thing is to look at the trend and also to compare against your peer companies. So this idea implementation of the signal capture, we're going to do a portfolio optimization algorithm. Just think back to Harry Markowitz, 1952. That's the beginning of it. And then, of course, in the, how many years has it been since 1952? Lots and lots and lots of decades, right? Even I wasn't born in 1952. So there's all sorts of crazy things out there to find. What are we trying to do? We're trying to minimize risk while maximizing return, or finding the highest return at each given level of risk in there. And so remember the assumptions that we made inside of that portfolio optimization. We'll talk about that in just a little bit. Risk management overlay. So this has everything to do with taking a view of the firm as individual silos versus an overlay of risk management principles. That's why the Institute and others out there are super big on hiring chief risk officers. In fact, do a little Google search. There are lots and lots of major colleges that have chief risk officers now, which I think, of course, is a great thing. And then a transaction cost analysis for trade execution. This can't be a bad thing, right? Marginal cost, marginal benefit. All right, here we go. This quantum alpha fund over the past 5 years. So what did we read in that first paragraph a few slides ago? Consistently outperformed. Well, let's go ahead and verify that. So year 1, that looks like outperform. Year 2, yes. Year 3, yes. Year 4, no. And year 5, yes again. So what we'll have to do is we'll have to calculate those up and down ratios that, what was that, question 3. So that should be a pretty straightforward answer. And then finally, we're considering adjusting its fee structure. So management fee of 1% now, but we're thinking of the incentive fee of 20% of returns above a certain benchmark. So that kind of brings in the specter of, kind of this hedge fund incentive fees and management fees and all that kind of stuff. So let's repeat the questions now that we're all on the same page, right? So first one, describe 2 potential benefits of that signal creation. So what did I say? Timely, unique, and interpreted differently or uniquely. And then capturing that signal. Then there's the 2 ratios, and then there's the fees and the volatility. So let's go ahead and start working on this first one. So notice the way we have crafted these questions. 2 points for this. Describe 2 potential benefits and explain how each might contribute to alpha generation. Remember, the name of this fund is called, Quantum Alpha. So that sounds like we want to ask that question. So let's go ahead and focus on that second one, the sentiment analysis of earnings call transcripts. Wow, what we can do is we can try to capture, we can try to extract some kind of qualitative information that's not reflected in those financial statements, which tells us that we can kind of get a sense of management tone, management confidence. If the executive leadership team, maybe it's the chief risk officer, maybe it's the chief financial officer, if he or she is saying things like, like this, hey, we're very confident, positive net present value, whatever that is, we can get that doesn't show up in those financial statements. Now, the key element here is that if we can find that, what did I say earlier? Boy, unique, right? So this is kind of unique here, sentiment analysis. Then what we can do is we can say, you know what, this due diligence, this work that we're performing today is going to pay off at some time in the future. And so that's going to contribute to alpha. How about the second one here, signal creation? Let's look at this third one through alternative data sources. So unique, there's that word unique again, non-traditional insights. What that could do, those non-traditional insights, what they might be able to do, it's not guaranteed, of course, is that can provide early indicators of shifts in all sorts of things, maybe consumer behavior, maybe industry disruptions, maybe interest rate changes, parallel shifts, whatever it could be, early indicators of shifts. We don't have enough information about this quantum, but you can get a sense that lots and lots of stuff out there might provide those earlier indicators, and that's going to contribute to alpha because we're going to look at these trends from the traditional data sources, combine those with the alternative data sources, and maybe we can find, I'm going to use that word again, a unique trend that nobody else recognizes today. Sooner or later they will, because of course sooner or later, we're smart people, right? We're going to figure this out. Maybe not today, but at some point in the future. Now, how about the signal capture stage? What are these 2 challenges? So this is what I was saying earlier about portfolio optimization. This is a great thing, but it may not account for, things that go on inside of policy statements and real world trading. Suppose that I have a limit. I'm one of your clients and I have a limit, and I say, you know what, I don't really want to short. I don't want to really invest in tobacco stocks. I don't want to do this. I don't want to do that. So there's all sorts of constraints out there that may impact that algorithm inside of portfolio optimization. Notice what we have in bold there. These could be liquidity issues. In addition to what I was saying earlier, they could be position size limits. They could be almost anything. What's the solution? The solution is to say something like, you would call me and say, hey, you know what, Jim, you need to be educated. So that's always my first solution whenever a client, poses some kind of a unique constraint. But that's probably not, kind of the broad answer that the CFA Institute is looking for. What they're looking for, since this is a quantitative model that we enter some practical constraints. Max position size, liquidity thresholds, trading costs, those kinds of things. And in addition to some of the other things that I talked about that will solve that problem. How about the second one? Transaction costs might not capture all aspects of the market. What did I say earlier? That doing this cost-benefit analysis is a good thing, but is it complete? So that's the danger here, is that if we have lots and lots of volatility, maybe large price swings upward or downward, then that's probably going to erode alpha. And notice what we have written there, especially in less liquid securities. And so the solution is to take a step back and say, you know what, let's go ahead and look at real-time market conditions. Let's do an analysis of liquidity. Let's do an analysis of maybe some of the composition of the portfolio and try to have some kind of an execution strategy that is adaptable to those real-time issues. What did I say earlier? This ought to be a pretty straightforward one. So let's go ahead and look at the up markets. Those were 4 years. So 12.5 is greater than 10, right? So you got the benchmark return greater than 0, the benchmark return less than 0. So we'd only have one year of the down market, 4 years of the up markets. And so these are pretty simple calculations. Like I said, let's just sum those and divide by 4. Let's sum those and divide by 4. And we get, what do we get there? 15 and 13.25. So the up market capture ratio is 113%. And then we can do the down market ratio, which is pretty easy because there's only one out there. So that's 62%. Now, make sure, I wanted to say this earlier and I forgot. Let me go back here. So make sure that when you're on the exam, you read both questions. So here we have them in bold. Discuss and then propose. Discuss and propose. I know lots of my students, and I'm guessing lots of candidates out there, will do the first one and then forget to do the second one. Now, you have a template, so hopefully the Institute is giving you a signal not to forget those, but still make sure that you're aware of the multiple questions that are embedded in each one of these. Here, all we're doing is calculating. All right, moving on to the last one. This is a 4-pointer. Explain how the addition of incentive fee would affect the standard deviation. So we put this incentive fee in there. What's that going to do to the volatility of returns? Now, one of the things that's emphasized inside of the learning module is that very first bullet point. So those incentive fees, they reduce the standard deviation of realized returns because what they do is that they kind of offset, right? In positive return months, those incentive fees reduce the gains. In negative return months, the absence of those incentive fees then leads to smaller losses. So you've got a lack of symmetry in here on one side and the other. And so instead of having this much volatility, you have, well, probably not this much, but you have just, well, the difference would be whatever those incentive fees are. So that magnitude of reduction depends on size of the incentive fee. That's what I was saying, this little bit over here. It's probably not going to be that much. And then remember in that last example, we had, what did we have? Four years where it was above and then 1 year where it was below. So what is the frequency and the magnitude? Here, let me go back here quick to that table. Where was that? Suppose that instead of, look, 12 and 10, 5 and 8, those are fairly close together. Suppose those were farther apart. Well, then back here you would get different answers there, but then you'd have, kind of a different conclusion based on this question 4. All right, how about 2 potential behavioral implications? Risk-taking behavior. If this incentive fee is based just on a pure management fee, the managers might decide that, what we want to do is say, we've got 100 million in assets under management. We just like to keep that because we're just getting 2% or 8% or 20%, or probably not that high, but whatever that is, we want to keep that because then that maximizes the fund manager's return. What happens then when you add the incentive fee, then you're encouraging extra volatility because the fund manager is clearly going to go ahead and take on more risk. But then of course, you have the downside to worry about. Now, how about this focus on performance? This will be the last one that we do here. So pure management fee may lead to complacency. So this is what I was saying just a little bit earlier. Focus on asset gathering, right? Generating extra contributions to the fund or new shareholders to the fund instead of trying to figure out, hey, what's the best thing to do? So adding that incentive fee, that's going to increase that focus on generating the alpha. And then, of course, we have got the extra standard deviation. So you have to worry about things like tracking error and all sorts of fun stuff. The answer says here, short-termism, that's one of those behavioral issues, or style drift. All right, so that takes us all the way to the end. So thanks for watching. What I would love for you to do now is we work through this. This was just a small part of this learning module. Go back, and I told you to do this during the original recording. Go back. I think there are 42 or 43 really, really good questions in this learning module. So that would take, the whole breadth and the whole depth of this particular topic. So hey, have a great day. Good luck studying.